We've had a huge play when we think about where gold was. We had the parabolic move that began in April, and then we did have what we called a range-bound market between the all-time record high at about 3,500 and then hitting a low back middle of May at about 31.28. From there, we've seen a solid rally from 31.28 up till the highs that came in on Friday, 34.54 right here. I do believe that if and when silver breaks above 37, we should get a sizable move, maybe as high as $40. However, you can see that back on Monday of last week, it traded just to 37, but did not have the power to run through it. We then saw it correct on Tuesday, Wednesday, and then you've got these very small body candles representing Thursday, Friday, and today.
Gold saw a strong rally starting in April, reaching a peak near $3,500 before pulling back to around $3,128 in mid-May. Since then, it has rebounded, climbing to about $3,454 by last Friday. Analysts say lingering uncertainty from conflict and trade tensions could push gold back near $3,500, while easing economic indicators and Fed policy may keep prices in a tight band. As for silver, it attempted to break above the key $37 level last week but failed, facing resistance and correcting over the following days. A breakout above $37 could lead to a move toward $40. Gary Wagner maintains a gold price target of $3,600 for the year, but was surprised by last Friday's surge following Israel's unexpected attack on Iran. This geopolitical shock sent gold prices soaring briefly. Despite continued conflict, gold prices have dropped while U.S. equities have risen. This suggests that investors believe the violence will stay contained between the two nations and not escalate across the broader Middle East, reducing the urgency for a safe haven rush into gold. Gold slid by more than 1% to around $3,417 as traders booked profits after its recent surge. Markets are interpreting it as a sign that the Israel-Iran conflict may remain localized, easing safe haven demand. Stock futures climbed while oil and gold prices eased, indicating growing optimism that the conflict won't escalate further. Analysts at Bank of America caution that unless the conflict spreads, gold is unlikely to reach $4,000. The current pullback reflects recalibration after recent highs. Gold futures opened at a record approximately $3,473, though gains faded as investors awaited the Fed meeting and clarity on geopolitical developments. Before we begin, don't forget to subscribe and hit the bell icon for updates. Please share your thoughts in the comments and let us know if you find the content valuable.
I am still holding to my upside target this year of 3,600. However, we hit an all-time record high on Friday, and so that came as a surprise to me. It wasn't, I could call it a black swan event. No one had any inkling that there would be the attack on Iran by Israel, and that, of course, moved the market sharply higher. So in that way, I underestimated the possibility. I do want to get that straight. But the interesting thing is, the fighting went on throughout the weekend. It's ravishing even as we speak, and yet gold is down, U.S. equities are up. And what that tells me is that the investors, market participants, professional traders possibly believe that this conflict will be contained between the two countries. And the fear on Friday was it spreading to a wider swath of the Middle East. And the fact that that doesn't seem as likely is why we are seeing gold trading lower today. That's my best read on it. And we'll talk about where it could go and support and resistance. But it does seem logical, even with the fighting, whether it's escalating, but still elevated, that we are seeing gold down today. We've had a huge play when we think about where gold was. We had the parabolic move that began in April, and then we did have what we called a range-bound market between the all-time record high at about 3,500 and then hitting a low back middle of May at about 31.28. From there, we've seen a solid rally from 31.28 up till the highs that came in on Friday, 34.54 right here. And then the open was even higher. When we look at the open that came in today, it came in around 34.70, but then traded tremendously lower, now hovering right above 3,400. This, of course, is the August futures contract, not spot. And so it's in a very precarious position. in terms of if we do see further decline, I've got a couple of red lines in here, and they represent a fib retracement from the beginning of this rally at 31.20 up to the high that came in today. And we're close to the 23% retracement. That comes in at 33.93. A break below there, we could see 33.40 on the downside if we do not get a deep correction. And I would assume right now that we could always see a deeper correction, but my assumption is that we're going to get a more shallow correction of a 38.2%. A deeper retracement, the deepest that we would ever see would be a 61% retracement, and that would take gold down to 32.50. I don't foresee that in the cards right now. Okay. So I believe that we could drift lower. You get a 2-day pattern simply called a engulfing bearish. Whenever you've had a sizable rally and you get this red candle as the daily candle that opens above the close on Friday and closes below the opening price. And so what we look for in terms of Japanese candlesticks is called a confirming candle. We want to see a red candle with a lower low and a lower high, and that would confirm that we have entered a correction. Right now, this pattern is ominous, and it shows that in fact could be the case.
Interesting. Okay. I mean, I wonder how long that correction's going to go on for. I mean, I mentioned that Fed meeting is Wednesday and markets are pricing in a pause, but there's concern Powell could signal a hawkish bias, especially with these tariff and inflation expectations rising. If we get a hawkish hold, I mean, what does that do to gold's chart setup? Is there a clear technical trigger you're kind of watching here?
Well, you're correct in the statement you just made. There's the probability of a interest rate cut on the 18th is nil, according to the FedWatch tool. But what traders are looking for is forward guidance, which is exactly what you're addressing, how Powell is going to reference everything. And I think that what he's going to do, because of the fact that the conflict in the Middle East just came up and it could affect oil, we know that oil is a very sensitive commodity in terms of the input of inflation. He will mention that, and he will probably something to the effect of, we want to watch this closely because this could change things. Also, the tariffs that Trump has placed and not finished negotiation, they're still elevated. We don't know what's going to happen this time. And so I think with those parameters, it's unlikely we get an extremely hawkish stance. I would imagine he's going to address the fact that they want to monitor inflation closely because the potential of oil spiking higher and the unknowns with the tariffs are something that the Fed's going to keep an eye on. And I think that they'll focus on that. It could be hawkish, but I would genuinely be surprised if he didn't talk about the concern he had for the potential price of oil, the conflicts that are ongoing, and the potential for inflation with tariffs.
Gary Wagner explains that gold is likely entering a Wave 2 correction in the Elliott wave cycle after a strong rally, Wave 1. If confirmed, gold could fall to $3,390 to $3,340, possibly even to $3,300, but a deeper drop is unlikely. This pullback is considered normal in a bullish trend, with the overall macro environment such as central bank gold buying, weak manufacturing data, and soft job numbers still supportive of the long-term upside. The speaker expects a short-term dip, followed by continued strength over the next 2 to 3 months. Silver has tested the $37 level, but hasn't broken through yet. It's common for price points like this to take multiple attempts, often succeeding on the third try. While silver isn't breaking out right now, it still has potential, especially if it can close above $37 for a few days. However, with gold under pressure, silver may also soften in the short term. Last week's move was strong but unsustainable. Regarding gold, a correction seems likely, but it doesn't mean the bull trend is over. If gold drops to certain support levels, traders will look for signs of renewed buying, such as a V-shaped rebound. As long as the macro factors driving gold higher remain, this dip would be seen as a normal correction rather than a reversal. Now, let's dive into the interview.
You know, the one thing that all of these technicals can show us is If it falls, what are possible areas it could fall? If it rises, where will it possibly find resistance? Now we're looking at the potential for a fall, so where could it fall to? It doesn't really address a time parameter, how long that would take to work out. What I can say is that we know this is an event-driven scenario. We are, in terms of the basic Elliott wave count, which is something that I look at, back at the beginning of a cycle, this move from 31 and change up to today's high is what we're labeling as a wave one. After it hit this top at 35 plus, and then we had what's called an A, B, C correction. So an Elliott wave, a bull count, you get 5 waves up, where waves 1, 3, and 5 go to the upside, the prevalent trend direction. You then get a correction. It works out in many different ways, but in this case, an ABC is what we've labeled it as. And the clock restarted back when we hit this low. So this is our wave one. This red candle, if we get a confirming candle, and I believe that's likely, will signal a wave two. A wave two can be a market move anywhere between, on the highest end, about 33.90 to 33.41. That's these red lines. And so how long it would take to kind of work out, I can't say. A deeper correction could take us to about 3,300. And I don't see it going as low as a 61.8%, but we could see gold go to 3,300. I think it's more likely that we'll see it go to 33.40. And that's basically what I'm looking at right now. Yeah. I mean, you don't want to count gold out for a couple of reasons, and central bank accumulation is probably the primary one. However, you're going to see peaks and valleys, even if the long-term trend, I believe, is still up. But I believe short-term, we are due for a correction. That's why I've given you those numbers there. But I do believe that the macros behind everything right now are going to move gold higher. But it has to, it doesn't have to, but typically corrects, which is a good sign of a bullish market, is to have a strong move up and then give back a portion of it. It's kind of like 3 steps forward, 1 step back, 2 steps forward, 1 step back. And that's what I believe we're going to see over the next, say, 2 to 3 months. We want to see what this correction looks like to see if it's going to be sustained or just a short blip. And we do want to look to buy these dips. The question is timing, when, and what price point to do that, which is why when we looked at gold, I gave you a couple of levels to watch. And if gold continues to drop and goes to those levels, you want to see a sign of what we call a V formation, in which we see buying coming back into the market. Paul Volcker put it best: trees don't grow to the sky. They never have. They never will. A price move to the upside is not going to just go forever. There's going to be a limit on it. And at that point, you're going to look for it to correct. However, if the variables that took gold higher are still prevalent in the market, you would look for it to be a correction and not a pivot from a bullish to a bearish market. And that should be the key in terms of what traders are watching, in that I am still bullish on gold, but I do believe we'll see a correction here. That doesn't mean that I believe that the bull run is over. I believe that a correction is possibly imminent and occurring right now, and that's a difference.
Both gold and silver are in a short-term consolidation or correction phase after strong rallies. While gold faces a potential pullback due to technical patterns and macroeconomic shifts, such as cooling inflation and geopolitical developments, the long-term outlook remains bullish, supported by continued central bank buying and weak economic data. Silver, meanwhile, struggles to break the $37 resistance but could rally sharply once it does, especially with repeated attempts to build momentum. Could a surprise Fed pivot or stronger geopolitical escalation reignite immediate upside for gold and silver? If silver fails to break above $37 in the near term, what lower support levels should traders monitor? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.